Derivatives. They're not just complex contracts. They are the keys to managing risk, spotting opportunity, and even finding risk-free profit. Welcome back to the Derivatives and Risk Education channel and to lesson 2 of the Derivatives Foundations course. We'll be talking about hedging, speculation, and arbitrage. We're building on what we learned about forwards, futures, and options from lesson 1 of our course. If you missed it, the link is below. But if you're ready to go deeper, let's get started. First, look at hedging. As we touched upon in lesson 1 with our coffee example, hedging is fundamentally about risk management. It's about reducing or controlling unwanted risks. Imagine a real-world business scenario. Global Tech Solutions, a US-based electronics manufacturer, sells high-tech components to a customer in Japan. They've agreed on a price of 150 million Japanese yen to be paid in 3 months. Global Tech is excited about the sale, but they face a risk, currency risk. Payment is in Japanese yen, but Global Tech's expenses are mostly in US dollars. If the yen weakens against the dollar in the next 3 months, when they convert that 150 million yen back to dollars, they'll receive fewer dollars, reducing their profit margin. To hedge this risk, Global Tech can use a forward contract. They can enter into forward contract today with a bank to sell 150 million yen and buy US dollars in 3 months at a pre-agreed exchange rate. Now, I should mention in trading, we use specific terms to describe our positions, long and short. Simply put, to go long means to buy and to go short means to sell. So remember, long means you benefit from an increase, like when you buy, and short means you benefit from a decrease, like when you sell. Back to our example. Let's say in the forward contract, Global Tech locks in a forward exchange rate of 110 yen per US dollar. That means for every 110 yen, they will receive 1 US dollar in 3 months, regardless of the actual spot exchange rate at that time.
Now, let's look at some potential outcomes. Scenario 1. The yen weakens to 120 yen per 1 US dollar in 3 months. If Global Tech hadn't hedged and the spot rate became 120 per dollar, the 150 million is converted to 150 million divided by 120, which equals $1.25 million. However, because they did hedge with the forward contract at 110, they will receive 150 million divided by 110, which is about $1.364 million. So they made a profit from the hedge of about $114,000. The forward contract protected them from the negative impact of the yen weakening. In scenario 2, the yen strengthens to 100 per dollar in 3 months. If Global Tech hadn't hedged and the spot rate became 100, the 150 million yen would convert to $1.5 million. But with the forward contract at 110, they still received the same 1.364 million. The loss from the hedge is therefore about 136,000. In this case, hedging meant they didn't benefit from the yen strengthening as much as they could have, but they still achieved a known, predictable dollar amount. Hedging provides certainty. It allows businesses to plan and budget effectively by locking in future prices or exchange rates.
Now, let's switch gears to speculation. While hedging is about reducing risk, speculation is about actively taking on risk, potentially profit from anticipated price movements. This time, let's use put options for our example. Imagine you believe that the stock price of Green Energy Co., which is currently trading at $80, is likely to decline in the near future. Instead of just selling Green Energy stock short, which has unlimited risk, you can use put options to speculate on a price decrease with limited risk. Let's say you buy put options on 1,000 shares of Green Energy stock with a strike price of $75, expiring in 2 months. Let's assume each put option costs $3 per share. Remember from lesson 1, buying a put option gives you the right but not the obligation to sell the stock at the strike price. Now let's consider different scenarios for Green Energy's stock price in 2 months. In scenario 1, stock price falls to $65 in 2 months. You were right, the price went down. Your put option with a $75 strike price now has intrinsic value. It gives you the right to sell the stock at 75, even though it's only worth 65 in the market. Profit per share from exercising the option is the strike price of $75 minus the stock price 65 minus the option cost of $3, so the profit is $7 per share. Across your 1,000 shares, your total net profit is $7 per share times 1,000 shares, so $7,000. Scenario 2, the stock price rises to 85 in 2 months. You were wrong, the price increased. Your put option with a $75 strike price is now worthless because the stock price is higher than the strike price. You would not exercise your option to sell at 75 when you can sell at 85 in the market. In this case, you simply let your put options expire. Your maximum loss is limited to the initial cost of the options, which is $3 per option. For 1,000 options, your total loss is $3,000. Speculation using put options allows you to profit from stock price decrease with defined risk. Your potential loss is capped at the option premium you paid, while your potential profit can be significant if the stock price falls substantially. This controlled risk is a key attraction of options for speculators. Finally, let's explore arbitrage, the quest for risk-free profit. This time, we'll look at futures contracts traded on different exchanges and in different countries. Imagine there are futures contracts on the FTSE 100 index, a UK stock market index, traded on both the Live Exchange in London and the CME in Chicago. Let's say at the same moment, you observe the following prices for futures contracts with the same expiry date. The Live FTSE 100 futures price is £7,500 and the CME $9,800. At this time, the GBP USD exchange rate, which we would call sterling, is $1.32 per £1. Is there an arbitrage opportunity? To find out, we need to compare the futures prices in the same currency. Let's convert the live future price to US dollars using the exchange rate. £7,500 times 1.32 equals 9,900 US dollars. Now we see a price difference. This indicates a potential arbitrage opportunity. An arbitrageur would execute the following strategy simultaneously: buy the FTSE 100 futures contract on the CME for 9,800 and sell the FTSE 100 futures contract on Live for £7,500, which is equivalent, as we saw, to $9,900. Each contract traded, the risk-free profit is the price difference, so $100 per contract. Remember, true arbitrage opportunities are very short-lived. As arbitrageurs exploit these price differences, buying on the CME will push the price up and selling on Live will push the price down there, quickly eliminating the arbitrage. So, in this lesson, we explored the three fundamental motivations for using derivatives: hedging, to manage and reduce risk, like global tech using forwards to control currency exposure; speculation, to take on risk and potentially profit from price movements, like our speculator using put options to bet on a stock price decline; and arbitrage, to seek risk-free profits from price discrepancies, like exploiting price differences in FTSE 100 futures across London and Chicago. Derivatives are powerful and versatile tools used across the financial spectrum for these key purposes. Understanding hedging, speculation, and arbitrage is crucial for grasping how derivatives shape modern markets. This was lesson 2 of Derivatives Foundations. In our next video, we'll take an in-depth look at futures markets. Make sure to subscribe to Derivatives and Risk Education and hit the notification bell so you don't miss lesson 3. See you next time.